Good afternoon or good morning, everybody. Thank you for joining us today for this presentation of Wavestone's results for the first half of 2020-2021. Pascal Imbert, CEO, and myself, Tiphanie Bordier, CFO, will present you the key figures of the semester and the outlook for 2021. As we reported last October, for the whole of H1, Wavestone recorded a revenue of 186.8 million euros, a decrease of 4%. Excluding W Group and on a constant forex basis, this represents a reduction of -7%. Just to remind you, W Group has been consolidated since August 2019. The use of furlough measures only affected about 6% of our fee-earning employees over the 6-month period, which was a result of better than expected business activity. For Q2, revenues stood at 92.4 million euros, down by 4%. At constant scope and exchange rates, this decrease was also -4%, so it was less pronounced than in Q1. The improvement comes from business activity being stronger than we had anticipated at the start of the summer. Let's now take a look at our KPIs. In H1, the utilization rate for Wavestone's consultants stood at 65%. The utilization rate recovered significantly in Q2 to 68%. This was helped especially by the enhanced business development measures we have put in place. Average daily rate was 850 euros in H1, a fall of 3% compared with the previous fiscal year. It's also clear that price pressures are here to stay, which means that we expect to see over the whole fiscal year sales prices that are about -3 to -5% lower than last year. Despite the concerns we had before the summer, our levels of order intake enabled us to maintain a stable order book at 3.7 months of work. Let's have a look at the major sector trends during H1 in the deteriorated market. The latest estimates put the decline in the consulting market at around -12% in Europe. First, sectors where there's been a clear contraction. These are consumer goods, which is down 21%, and transport and travel, down 17%. Also, but to a lesser extent, services, which is down by 11%. These are, of course, the sectors that have been the most affected by the consequences of the COVID crisis. Next, there are sectors where the effects have been less pronounced. The financial sector first, where a more modest contraction of 4% reflects a combination of the sharp downturn in banking, counterbalanced by a very dynamic insurance sector that saw 32% growth in H1. Similarly, the decline in the industrial sector was limited for Wavestone, mainly as a result of solid growth in pharmaceuticals. Last, there are two sectors that have been cushioned us from falling demand. First, energy and utilities. Here we've seen strong growth of 18%, and to a lesser extent, the public sector, where we saw a 3% expansion. Wavestone workforce contracted by -5% over H1 and stood at 3,324 employees at the end of September. This is a direct result of the recruitment freeze we put in place at the start of the COVID crisis in March. As our visibility on future projects improved toward the end of the summer, we decided to gradually resume hiring, initially in the most resilient practices. And on staff turnover rate, on a rolling 12-month basis, this had slowed to 13%, which compares with 14% during our last fiscal year. We have found ourselves slightly behind schedule on our half-year closing work. The figures I'm going to present to you are still being reviewed by our auditors. but we really don't expect to see any variation in the figures when they are finally adopted. In terms of profitability, Wavestone generated an EBIT margin of an EBIT of 14.3 million euros. In the context of a contracting consulting market due to the health crisis, our EBIT margin held up rather well at 7.7%. I should add that the use of furlough measures contributed 2.8 percentage points to this profitability. Before turning to the income statement, I'd like to give you the detail on a couple of items. First, you can see that personnel costs have risen by almost 10 million euros. This is caused by the growth in the workforce due to the very strong recruitment that took place last year, and by a scope effect linked to W Group. These elements are only partially offset by the savings from the furloughing of staff. Also, you can see that our external charges reduced significantly over the period, by nearly 13 million euros. This follows naturally from the implementation of the saving plans, which accounts for almost 11 million euros. After amortization of client relationship and after other operating expenses, the operating income stood at 13.5 million euros. The cost of net financial debt is falling due to the firm's deleveraging and the cost of credits. After tax charges, group share of net income was 7 million euros. Net margin for H1 was 3.7%, compared with 4.8% a year earlier. I'd now like to turn to our cash flow statement. You can see that we generated 18.8 million euros in cash from business activity over the period, thanks in particular to the optimization of working capital requirements. Over the period, the company paid 10.5 million euros in tax, a largely stable level compared with last year. In the absence of any acquisitions over the period, and as a result of the performance plan, investment operations consumed only 0.5 million euros over H1. Cash flows related to financing consumed 38.7 million euros. They were essentially made up of 34.1 million euros in loan repayments. I should also remind you that the company didn't issue a dividend in H1. On the balance sheet, you can see that shareholders' equity has increased by 7.6 million euros, reaching 184.7 million euros at the end of September. Goodwill decreased by 5.3 million euros, notably due to removing provision for the second W Group earnouts. At the end of September, the firm's net financial debt had fallen to 15.6 million euros, compared with 29.1 million euros at the end of March. I remind you that the latter benefits from the postponement of the payment of the employee profit-sharing payments for 6.3 million euros in December. We are therefore able to continue to meet our banking covenant with Pascal, who will take you through the outlook for Wavestone.
Thank you, Tiphanie, and hello, everybody. Let's take a look now at how Q3 of this fiscal year is likely to unfold and what it means in terms of outlook for Wavestone. The autumn saw a worsening of the public health situation, which resulted in a renewed lockdown during several weeks, and which has led to a tightening of preventive measures that could last several more months. In the short term, these developments, in particular the return to lockdown, have had a very limited effect on Wavestone's operations. So that picture seems unlikely to compromise the rise in the consultant utilization rate that we expect in Q3 and that we are targeting in Q3. In the longer term, this backdrop is going to lead to renewed uncertainty, especially over the early months of 2021. We think this could encourage clients to take a more cautious approach when committing to expenditure. Nevertheless, we expect demand to remain strong in several areas like cybersecurity or like the optimization of our clients' information systems. And some trends that have emerged in recent months should continue to gain momentum. I'm speaking of transformation projects, which the crisis is tending to accelerate, and also M&A operations and carve-outs, which are on the increase. Against this backdrop, the battle plan we've been pursuing since the start of the fiscal year remains core to our strategy. In particular, we are maintaining very intense business development activity, and we are absolutely focused on adapting our priorities in real time to developments in the market landscape. We are also taking additional stimulus actions targeted at practices and offices that are lagging in their recovery. We are also actively preparing for the start of 2021 so that we can minimize any staffing disruptions that could result from the uncertainties I've just mentioned. Our performance plan remains entirely relevant, a plan now targeting savings of 16.5 million euros over the whole of the fiscal year, compared to the 15 million euros initially targeted. I should ask that this figure does not include any effects of furlough measures and assumes no adjustment to our workforce. In addition to pursuing our battle plan, we are taking a progressively more bullish stance since September. First, we've almost completely exited from furlough measures, which remain in place only in the UK. Then, and especially, we've resumed activity on recruitment, activity that is being gradually extended across our offices and practices as soon as their performance returns close to normative grounds. Our aim is to achieve over 400 gross hires over the second half of the fiscal year, of which 300 new starters before March 31. This renewed recruitment is being facilitated by a labor market that has largely eased compared to the pre-crisis period, with starting salaries that have stopped rising and remain, in fact, identical to the 2019 market norms. Restarting recruitment should enable us to stabilize headcount over H2, but we are unlikely to get much beyond that, given the recruitment freeze over H1, and given that staff turnover is in fact only falling slightly. We therefore expect, over the whole of the fiscal year, a drop in headcount of about 5%. Last, we've taken the decision to restart our external growth activity. We'll be prioritizing international operations. However, that won't stop us from making tactical acquisitions in France. Let's turn now and finally to our quantified objectives. For Q3, as I mentioned earlier, we intend to continue improving consultant utilization. We've even adjusted our target upward and are now aiming for a utilization rate over the quarter of more than 72% instead of 70% previously, 72% compared with a rate of 65% in H1. Sales for the quarter will nevertheless be down due to the workforce contraction since March 31 and due to the fall in sales price. We expect the decrease of the quarter revenues to be of the same order than the 4% contraction we saw in H1. In addition, we are now in a position to set financial objectives for the whole of the 2020-2021 fiscal year. Those objectives are to generate a revenue of over 400 million euros and to achieve a double-digit EBIT margin. That's it for the comment we wanted to share today. Let us thank you for joining us, and I wish you all a very good end of the day. Thank you.